I've grown my capital. I'm doing infinite banking. I've got this nice pile of cash now. What do I do with it?
How could we move that retirement date up from 59 and a half to 55 or 50? Within a couple of weeks, we had pulled money out of our retirement, paid the penalty, paid the taxes on it, and bought a property. Usually we see between years 4 and 7 that there's been enough equity gains that make sense to either cash out, refinance, or sell the property and continue to grow the portfolio.
My properties are in Harrisburg, Pennsylvania, and Evansville, Indiana, which I've never been to either. I've never seen the properties, but you guys pick markets that are just kind of muted on the growth in both directions, just slow, steady, consistent markets.
When the property values don't skyrocket, they also don't plummet because they didn't have an artificial increase in the first place. If you focus on it for 5 years, you're not only going to create a self-sustaining business, but a self-growing business.
The returns go from potentially, 10%, let's say, on your investment to almost infinite when you consider the fact that you're using other people's money.
For every dollar that's coming out of my system, 2 are flowing back in. And that's current cash flow now, not future value that I can't touch until I'm 65.
Hey, what's up, folks? Another episode here. It's now December 2nd. I can't believe we're already at the end of the year. Exciting time to do it, but we have a special guest on today, Shane Thompson with RP Capital. So some of you, as our clients, we've introduced to RP Capital. It's where Hans and I have both bought some of our rental real estate through their services, and really they've done a phenomenal job. So we thought we'd bring Shane on to talk about what he does and how it fits into the overall model of what we do. How you guys doing?
Great. Good. Glad you can have me on. Appreciate being here.
Yeah, doing good. Glad this worked out. Been trying to sync it up for a little bit, and I think it's a good time because often people ask us, I've grown my capital. I'm doing infinite banking. I've got this nice pile of cash now. What do I do with it? We position ourselves in the protection and savings component. We will tell what we do to grow our capital, but we're not financial advisors. We don't give financial advice, but we will say what we do. And what we focus on primarily is real estate, at least at the moment. And for me, that's entirely through you and RP Capital. We want to hear a little bit about how you got into real estate, just your background, some basic bio. At the end of this, what we would like is for people that have that question of what do I do with my capital now, to have a point of contact to reach out to. We'll put your contact information in the show notes if they want to explore this idea. But we want someone to go from having no idea what a turnkey rental is, but is interested in growing their capital, to understanding what you do. So maybe a little background of how you got into this, your background with real estate, how you got into RP Capital, et cetera.
Well, I started out, out of college, I got a degree in construction management and started out on a hospital project. It happened to be the first project that I got put on as an entry-level position as a project engineer. And I loved it. I loved being part of the construction process and building something as cool as a hospital. But once you become a healthcare specialist, they keep you in that. And so my wife and I, we moved all over the country. We lived in 7 different states in the 8 years I worked with that first company. My wife was very clear that, yeah, this is fun for you, but I don't want to keep moving around like this. We had our first daughter, and she was like, yeah, this is getting old pretty quick. So I thought, okay, I get that. So we knew we weren't going to do that forever. So then I changed to a different company that was more local. I'm here in Utah, but we still built hospitals. And so I thought I'd solved the problem. But then it's a very demanding career, I guess. And so it's almost similar to your guys' stories of how, COVID kind of forced you to start thinking outside the box and some different things happening in your work lives. It was similar there. It was like, man, I don't want to do this forever. This is fun and rewarding, and I like that part of it. But just to do that day in and day out for a 30 plus year career, just started to not feel like something we wanted to do.
So if you moved around for each hospital project, how long does it take to build a hospital?
Really depends. I worked on projects anywhere from, like a small remodel of one floor within a hospital all the way to a ground up, full service hospital and clinic. So did projects anywhere from 6 months to 3.5 years.
And then once that project's done, unless there just happens to be another one in the same city, you're sort of looking for the next gig.
Yeah. Yep. You work yourself out of a job is what they always say in construction. That one's done, you move on.
You may actually move more than military folks do. We're every 3 years typically, so you're even more frequent than that.
And a lot of times well in advance where you're moving to, as I understand it. a lot of times we didn't know, the project's coming to a close, you only got a couple months left. And I remember my wife telling me like, well, can you ask where we're going? Because we know the project's ending. This other job that was supposed to come online around the same time, we were supposed to flow right into it. And that didn't work out because of delays in permits or whatever. And so I was like, they'll tell us when they know. Like it's not like my boss is a jerk or anything. He just doesn't know where I'm going to go. And she's like, just ask him. And so I asked, and I remember him being like, well, yeah, I understand your wife's getting antsy. It could be this project in Texas, or it could be this one in Florida, or it could be this one in Pennsylvania, or it could be, he's just, I was like, never mind. That's not helpful at all. There's, you just didn't know. So once we got out of that, it got better, where I still just worked in healthcare projects, but they were only local. But again, like I said, it was still a lifestyle, so stuff with the kids and lots of different things. So yeah, at that point, just started looking into, okay, what other options are there? We had put a lot of money in just the traditional, 401k, and we had each done IRAs, both Roth and traditional. And so started looking into that. And I remember running a calculator that showed if we continued to contribute at that pace, it was in our late 20s at the time. If we continued to contribute at 59 and a half, we'd be great. I don't remember how much the money was, but I was like, okay, well, that's awesome. 59 and a half, I'll be good. What about before then? Like that's what I wanted to focus on. I want to be there more available when my kids are still at home. I don't want to, then they're gone and then I've got time. That's not as helpful, because then they have their own lives. And so really wanted to be like, how could we move that retirement date up from 59 and a half to 55 or 50 or 45? Like, who knows? I didn't know what the possibilities were, but just started looking at other options. And that's when I just started listening to lots of podcasts about real estate, reading everything I could find, and looking at different things. I bought lots of programs, from gurus, and learned a lot, but didn't find anything that was a good fit. Tried several different options. And then I came across RP Capital through a friend, and just happened to go to a presentation where Ron Phillips is the owner of the company, and he was doing a presentation live here in Utah, and saw it one time, and I was like, yep, that's what I got to do. So within a couple of weeks, we had pulled money out and of our retirement, paid the penalty, paid the taxes on it, and bought a property.
Well, you said when you're exploring real estate, what kinds of other real estates were you looking at that didn't really work out until you found this turnkey model? Because for me, my entire exposure to actually being a real estate investor, besides buying and selling a personal home that happened to appreciate in San Diego, has been with you and with RP Capital. So were you doing fix and flips? Were you doing commercial? What were the ones that didn't work out before you got to this one?
Yeah, good question. I remember trying wholesaling. I remember writing yellow letters and doing the addresses, and sending letters out to lots of people. And we only did that for a couple of months, I think, because then we ended up getting transferred from that project sooner than we expected. And so it's like, well, there goes all that effort. It takes time to establish things, and that just wasn't a good fit for my personality and everything, I think, anyway. But yeah, so wholesaling, rehabbing, did lots of, because I was like, well, I'm in construction, I'm familiar with a lot of those processes and everything. So learned a lot about it. Didn't go too far down that road. Definitely tried a lot flipping, buying lots for less expensive than what they could be for. So kind of a wholesale process as well. Tax deeds. At the time, there was a lot of underwater jumbo loans. That was another process. So really not necessarily just in real estate, but also kind of the financing alongside of it, and tried all these different paths, but they were all kind of starting a whole nother business, and doing that part-time on the side wasn't really to start something from the ground up, was tough. And so buying a property that I didn't have to go see, we lived in Utah. The first property we bought was in Florida. I never saw it. We got tons of pictures through inspection reports and appraisals and property management, walking through and taking photos and talking through with them all the details and on questions that may have come up on expenses I need to pay for and things, but never did see it in all the years we owned that property. And so that was just a much more passive approach that fit more with my demand on my time. I didn't want to work all day at a demanding job and then come home and then spend more hours researching and trying to get this other business off the ground and things. And so it was a really good fit, just buying a property, having the property manager do all the heavy lifting. They're the ones placing the tenants, they're vetting the tenants, they're doing all the work, and then they're just communicating with me. And after you get it going and the process rolling, after that, it's really just email communication. I get a statement from my property managers once a month that says, this is the money that came in, this is what we direct deposit into your account. And it's no effort on my part. I just get a quick check-in and I'm like, all right, yeah, looks like the tenant paid. Great. Or if there's a maintenance request, I'll get an email from the tenant. But super passive and easy. And that makes it easy to repeat the process. You don't get overwhelmed by owning multiple properties because it's so simple.
You still own that property in Florida?
Good question. We actually sold it last year.
Oh, no way. How long did you own it?
13 years. And the typical, and this is part of something that I do for clients is we review the property performance every year and see how things are going. Because we have long-term projections on every pro forma we send out. Nobody knows the future, but to project how things are going to go as best as possible, you base it on as much historical data as you have available, right? And so RP Capital's been doing this for 19 years, sold thousands of properties, and they're linked to the property management systems. And so they know, hey, an average property is going to have this much in vacancy and this much in maintenance and this much in rent increases and all those things. And so we project those out and see when we think it'll make sense to either sell that property or cash out, refinance it as you build equity in the property. But we got to evaluate it in real time and see, okay, what's actually happened on this property? Where the value's at? What are the interest rates doing? What's the rent band? And so we did those evaluations and basically after 4 years, it made sense. Instead of selling it because interest rates had gone down, we did a cash out refinance. So we were able to pull basically $50,000 out and buy another property, but our payment on the first property was still the same just because the interest rate was lower, even though our principal balance was now higher with the refinance. So I was like, oh, well, that's a no-brainer. I can have the same payment, same cash flow, and pull money out and buy another property. Absolutely, do that all day. And then in another 4 years, around year 8, it made sense to do it again. So we pulled about roughly another 50,000, bought another property, held on to it. It continued to grow. And then we got to the point just this year in year 13, where we were going to do the same thing, refinance again. And then the appraisal came back like 20,000 higher than we were expecting. I was like, all right, we've started to get more maintenance costs as this thing's now 13 years old. And so I think it now makes sense just to sell it, do a 1031 exchange. And so we had enough in there that we bought 3 more properties at that point with it to replace that one. It varies, every situation's different, but usually we see between years 4 and 7 that there's been enough equity gains that make sense to either cash out, refinance, or sell the property and continue to grow that portfolio.
So I have a couple questions here, but naturally I would have guessed if you tell me that you tried a bunch of different things in the real estate world, given your background, I would have thought you'd have landed on fix and flip. It's cool to know. It's kind of validating that you as a construction expert still found this turnkey. But before we move on, I think it'd be good for you to just explain what a turnkey rental is for someone who is not familiar with the terms we're talking about. People are familiar with buying a house, but even if you've gone through that process a couple of times, what specifically is the process with RP Capital? If you want to get a turnkey rental, what does it actually look like? Because a big question people ask me is, do they just hold my hand through the whole thing? I don't do anything. Do they buy the property and then I just finance it? So a little clarity on what RP Capital actually offers as far as getting these real estate investments.
One thing that I kind of realized really early on in the rehab process when I was investigating that was that you've got to do a lot of volume to be able to keep the subcontractors wanting to work for you. And so if someone comes in and only has enough funds to do one project at a time, you're going to be the last guy on the list for who they're going to serve, right? They'll say, yeah, the electrician will be scheduled on your job next week, but then the other person that's doing 10 flips a year is going to be their priority. And so you're going to get put on the back burner over and over and over. And so you're going to get delays over and over. And so I realized that pretty quick. I was like, man, you got to have a lot of funds to demand to really grab their attention and get them to work with you. So that was one of the main deterrents on that side of it. And then as far as the turnkey portion, what that means is that if you took that away and say when I started, say I didn't have RP Capital and say I just said, hey, I've heard Florida is a great market for investment properties and I'm going to do all the research myself. I'm going to look for deals that make sense financially, meaning that the property will cash flow. So all of the expenses are going to be paid for by a 1-year tenant being in place. So if the mortgage, the taxes, the insurance, property management fees are going to add up to say $1,000, then I want the rent coming in to be like $1,300 or that's just a rough example, right? And so finding a deal like that in the first place is hard enough in most markets. And that's why, I live in Utah, but the properties that we have are all in other markets, in the Midwest and in the South mainly, where the numbers make sense. Because if I bought something here locally, it would not, it couldn't cash flow unless I bought it in a distressed state and put a ton of work into it. So to have something that's rent ready. So these are brand new construction properties or have just barely been rehabbed. So they're in great condition. They're ready to go. And so that's part of the turnkey process, is that you're not participating in the rehab risk or the construction risk at all. You're getting the property after that work is done. And you may get it under contract before it's done, but there will be inspection reports and appraisals and all those things to make sure before you close, it's in the best condition possible. If there were any repairs needed, they've been made. The warranties in place from the seller, just all those checks and balances to make it as safe as an investment as possible, as we can humanly know at that time how the property is going to perform. So it's turnkey in that you're not having to buy appliances or blinds or anything after closing to get it ready for the tenant. And that's also turnkey in that if you picked a property by yourself, then the next thing you'd be doing is, okay, well, now I need to be Googling a bunch of property managers in the area. I need to be Googling insurance carriers. I need to be, who do I want to do title with? So what about lenders that will loan in that state? All that is so much research and effort. And even then you're relying on Google reviews, unless you happen to know someone that has worked in that market specifically and knows a lot of details about some different players in that market. So RP Capital already has these relationships in place. We know the property managers in that market. We know what their processes are. We've worked with them for years now in most cases. And so there's that trust as well that we can say, yeah, you're buying a property, it's going to be great. And here's every contact you'll need to make sure it's successful in the long term. In addition to that, I often explain it that my role, even after you close, is like a franchise mentor. That any questions come up, I've been down this road several times. I am an investor. We have these larger relationships with the property manager and the lender and all these things. And so if you have any questions down the road or you're not getting the response you want from them, it rarely happens because we do refer great vendors, but just because we refer them today doesn't mean they will be forever. People leave companies, change positions, retire, whatever the case is. And so we're there to help you shift in that process. And so it's that ongoing help and service as well.
You sort of alluded to two things there that I think that really mattered to me when I bought my first property with RP. One is that like you mentioned, you're up against people who have a lot of work with, say, a property manager or a contractor. And if you're just a single person with a single home, you're put on the back burner all the time. And the second thing you mentioned there is that you have these relationships in other markets. So you win on both sides of that. So when I bought a house in St. Louis, I don't know the people there. I don't know anybody to do any of the contracting work. And some of your other investors might only have 1, 2, or 3 properties there as well. So none of us carry massive weight with those property management companies. But because we're all referred by RP Capital, it's almost like working in a conglomerate of, 50 investors that all have properties with them. So if they start not providing optimal service to me, I can come to you. You can reach out to other people in that network. How are they treating you guys? And as a group, it's almost like coming in, sort of like a union effort. Now you have 50 homeowners working with that property, all referred and working with RP Capital. So you have that power of the numbers where they start letting me down. Ultimately, that's going to spread to everybody that you've brought in. In other words, they don't do that. I love that about that, because I can't buy a house in St. Louis where they've never seen me face to face and expect them to provide top service on my own.
Yeah, it is a powerful principle. It's the benefit of buying in bulk, and the insurance carrier that we use is really a very tangible example of that. So before we had this master insurance policy, the liability coverage was $300,000 per property. And then once we got this master insurance policy, they were able to look at it and see, okay, of all the pools of properties that we insure, the ones that come from RP Capital have the least amount of claims. So they're able to more confidently provide better coverage for less cost. And so after we got that master insurance policy in place, the liability coverage per property went from $300,000 up to $2 million. And it's up to everybody what they want to do. But a lot of people started looking at that like, man, if I got that much liability coverage, I don't even need an LLC. And that's a personal question, and that's up to everyone individually. But it provides options and things like that when you start getting those kind of benefits.
So another benefit, you mentioned the property manager, the insurance, the relationships that come inherent to working with RP Capital. The markets that you guys choose are, you're not going to be in Phoenix and Vegas and Atlanta, where, these explosive markets that when the downturn hits, they plummet. My properties are in Harrisburg, Pennsylvania, and Evansville, Indiana, which I've never been to either. I've never seen the properties, but you guys pick markets that are just kind of muted on the growth in both directions, just slow, steady, consistent markets. Like Brian said, a lot in the South, a lot in Alabama, a lot in Oklahoma, places with great numbers. But on the numbers, that's another thing that is removed from your plate. The contracts are already negotiated. It's not like you see a listing price and you're going to be going back and forth with the buyer's agent or anything like that. If you see a $150,000 property and the pro forma, you guys have already worked the numbers with the seller. So as the buyer logging into the portal, you're not looking around Redfin to try to find these properties. You actually get a investor portal on the website, and your portfolio is there with however many properties are currently being sold. And you see, here's the selling price, here's the down payment, here's expected, you're still taking out the mortgage, so that those numbers could vary a little bit, but here's at the current rates, here's what you could expect. So you're not doing this negotiation. It makes planning a lot easier. It's just taking one more thing off of your plate. And people might be asking, what's the price range? So I'm on the lower end. I think my properties are 130 and 150. I'm listing my first one to sell right now, and I'm going to 1031 exchange that into a property that's about 180, which is about what I'm selling for. So that I'm in the 150-ish average range right now. So you can get these fairly cheap compared to what your home market might be. But what's the general range of prices? And then also, if you have any more thoughts on the markets you guys pick.
So the general range, what you've mentioned is kind of the lower end that we see, typically around that 130,000. The most expensive properties we have right now are around 600,000, and those are typically new construction duplexes. We do occasionally have small multi-unit apartments with like 8 to 30 units somewhere in there, and those can get up into the millions. But those are more like a few times a year that we have those, and financing works out, and the commercial financing world has been difficult over the past few years. But yeah, so in general, you're looking about 130,000 to 600,000 on the purchase price. We're typically seeing 25% down is what we recommend for the down payments on these properties. Duplexes and up, they have to be a 25% down per lending regulations. If it's a single family property, you can just do 20% down on investment property. But it usually makes sense, if it's an option, to do 25% down even on a single family to get the better interest rate. It's usually worthwhile. But as you mentioned, the pro forma is one way to put the deal together and to structure the numbers and everything. You'll obviously have the option of how you want to do that as you start talking with the lender, and they present the different options, and they'll show them side by side, and you can look at it and say, okay, yeah, this is the one I want to do with this much closing costs and this much interest rate and those types of things. A couple things that we look for first is that first, they got to be landlord friendly states. That's really big for us and big for any investor, really. You've got to have a way to know that a tenant can't just squat in your property for 6 months, a year, whatever, without paying your rent. Nothing will kill your cash flow more than that.
So red states.
Yeah, pretty much. Then the property manager knows the process for that, and they're going to be able to jump on that quickly too and say, hey, if you're behind on payment, here's the eviction notice. Most of the time, the tenant ends up paying. They're just kind of testing the waters and saying, what are they going to do if I don't pay? And then the eviction notice comes, and they're like, okay, I will pay. They know that they're serious, and they can do that quickly in those states. So that's the first part of it. And then they got to be emerging markets. So there's lots of reasons to live there, lots of continued growth coming. So if one industry shuts down or one business shuts down its doors, it's not going to become a ghost town. Lots of reasons for tenants to live and work there. And then, as you mentioned too, that now that we've seen a price increase over the last several years, some markets that we used to be in, the numbers don't make sense anymore. They don't cash flow anymore because they have gone up in value. They are more volatile markets like that. So even going back to 2008, the markets that we're in now, they didn't really experience the downturn that people did in lots of other places. I ran the numbers for a guy the other day, and it was asking that. He was very concerned, and he lived in Washington State. And so I was able to show him the numbers of what happened in his state from around 2008, and the property values dropped about 25%. And then I showed him the properties he was looking at in Oklahoma, and it dropped about 3% from absolute peak to absolute low, from 2008 to 2011, somewhere in there. And so when the property values don't skyrocket, they also don't plummet because they didn't have an artificial increase in the first place. But they also have just a shortage of housing in all these markets as well. So low on supply, increases demand, which means prices continue to go up. So we typically just show on our pro formas a 3% appreciation rate per year, but it's often more than that. And that's why, again, we do those evaluations and help people take advantage of the appreciation they've gained sooner than what we initially expected.
I was actually looking at some of the properties on the website prior to this, and some of the ones that are on the lower end, like Hans was talking about, are in some of those southern places, Alabama, Georgia, South Carolina, etc. And the higher end, like you just mentioned, Oklahoma, there's a lot of new properties that you're selling, a lot of duplexes and not a lot of brand new builds. So what are you looking at in something like Oklahoma that gives you the confidence to go with new construction? Because if I get on Better Pockets or Bigger Pockets or something like that, everybody's talking about, you make your money when you buy. So you want to buy distressed property, you want to buy property cheap, you want to do things like that, add value to it. All of that is true and it works. I'm not discounting that, but it's a different model than what you're doing here. Because if I'm buying a place that was built in 2024 in Tulsa, Oklahoma, there's no value add that I can create now, right? So what's the benefit of doing something like that? And is that because it's an emerging city or, new industries coming in? What are you looking at? What are the metrics there?
Yeah, we're not discounting rehab and value add at all. It's just more effort is really what it comes down to. This is the passive way to invest. And if you want to line up contractors and do that, the rehab, you can even do it remotely. I have never wanted to, would never do it. The amount of, in addition to the effort, it's a lot of risk.
It's a headache.
Right. You just don't know what's behind those walls until you open it up. And so any rehab budget it's easy to get blown. So yeah, the passive part of it. And with new construction properties, they typically do appreciate better because they are going to be in parts of town that are growing. They may have the new Walmart going in or the new school being built or something like that nearby that's going to help with the appreciation as well. The cash flow is usually a little bit less on new construction properties compared to the properties that have been rehabbed. And so what I've found is we like to go, my wife and I on our portfolio, we like to buy one every other, and we kind of go back and forth, and we get one new construction property and the next one's going to be a rehab. So that balances us out with high appreciating and high cash flowing properties. Because I have done evaluations for clients who are like, man, I'm getting killed on maintenance and tenant issues being late or whatever. And I looked at his portfolio and he owns like 10 properties under $130,000. I was like, ooh, it's good to have some sprinkled in there, but I don't know if you want to have a whole portfolio of that. And that's what can happen. And then on the other end of the extreme, I've reviewed portfolios for clients who are like, man, I don't have a lot of cash flow and the appreciation takes time. You might buy a property in those first 2 or 3 years. You're not seeing a lot yet. And that is one of the largest mistakes that I see, I guess, is you got to go into this with a long-term view. It's like, hey, a 4 to 7 year window is when you're going to be really seeing the money. So if you sell it in year 2 or 3, you've cut your own legs out from under you pretty good.
That should really speak to the folks who listen to our podcast, because everything we talk about is thinking long-term. So when we're talking about infinite banking, whole life insurance, and generationally speaking, we're always talking about, even with what we do, a capitalization period for infinite banking and thinking 70 years out into the future. So really it goes hand in hand so well with what we do. And that's an awesome thought process. But how do you choose the new construction cities or towns or whatever?
We're always looking for cash flow. It's got to have a cash flow of a minimum. Right now, we're seeing typically 6% on the cash ROI. So that's first and foremost, because you want to have that cash flow, even if that's not the highest return, just to cover any vacancies and maintenance. You're at least going to be breaking even with that, but then you've got the larger appreciation. So yeah, Oklahoma and Missouri, where most of our new construction properties are, and they've seen very good appreciation over the last several years, but it's not so much that they're going to plummet. It's not an unreasonable amount that they've appreciated. And there's just, again, a shortage of housing. We've seen it a lot in Oklahoma, where new construction has been happening in Oklahoma City and some of the larger areas, but then these smaller, less populated areas like Tulsa and even smaller towns, a half hour to 45 minutes outside of Tulsa, no one's built a new house in 20 plus years. And so they have population growth as well. And they're there's lots of reasons to live there too. So those markets have been attractive for investment properties recently as well.
One cool thing that you were saying as far as the cash flow, and this goes back to when you're talking about your decision of refinancing, the rates were lower, you kept the same, you reduced your monthly payment, even though you had a larger mortgage. That speaks to how we talk about cash flow versus net worth, and net worth doesn't pay the bills, cash flow pays the bills. And that's kind of the paradigm shift that I had to make, that a lot of our clients have to make when you grow up with the CFP, Dave Ramsey, just where everything is with a target date of 65. That's our goal. That's when we're going to grow this big nest egg, and then we'll start living. And we're not really thinking about cash flow right now. But when we're talking about using rentals as cash flow, we're thinking about how having this property now can pay the bills in the present, which allows us to do more optimal things with our money, et cetera. And so that's a cool, the cash flow versus net worth mindset is really interesting. And I think that stood out to me that you said we lowered our monthly payment, even though we increased the size of our mortgage because you had paid it down for a while. Now you take out a larger chunk of debt, but you increase your monthly cash flow. And that actually matters more, because what you've since done with that, the proof is in the pudding. You now have 3 properties from that one. And that is the power of thinking about cash flow over this future net worth date. So I'm curious, how many properties do you have now?
We have 8 right now. And I like what you're saying. And the cash flow is good to live on now. But something that I always point out too is, if you're getting your first property for $130,000, you're going to be increasing your cash flow like $300 a month, right? Which isn't life-changing. I mean, that's helpful. You're not going to not take it, right? But it's not, you're not quitting your job or anything like that. And so what I often try to help people understand is that if you repeat that process, and so pick up another one in year 2 and then another one in year 3, or however much you're able to do, that if you really focus on it for about 5 years, and when you're in year 6, the property from year 1, you're able to sell it and buy 2 more without any more money out of your pocket because the property made the money. And then in year 7, you can sell the property from year 2 and buy 2 more. And so if you focus on it for 5 years, you're not only going to create a self-sustaining business, but a self-growing business that's going to just continue. That thing will be, the snowball part of it will just continue without any more money out of your pocket. You continue with your other investments after that point.
You're describing my situation exactly. Early last year, I got my first property. It was $130,000. I use a policy loan, and that's a cool tie-in of what we both do is I use other people's money. That's a big term in real estate. I use the insurance company's money. So the only cost to me is the interest on my annual policy loan if I choose to pay it. So that netted out. I borrowed $30,000 for my $130,000 property, put that towards the closing costs. So I'm incurring about $1,500 a year in interest on this policy loan if I choose to pay it and keep that static. And so, yes, I'm only getting about, like you said, I'm about $300 a month cash flow. That's not life-changing. In 6 months, I've paid off that policy loan interest, right, at $1,500. And so the other 6 months of the year, that is actual cash in my pocket. Now I just put that back right into the policy loan. But by doing that, I am minimizing the risk to my principal. Had I just put that money into the property, if my property goes up in flames tomorrow, I've still got my huge life insurance policy just collateralized for the policy loan. But my goal when I started this was 10 properties by 40. I was, I think, 34 for a couple months when I got my first one. So I want at least, start with 1 or 2 a year in the early years, and then using that strategy to leverage it. And so that's actually why I'm selling my first property, because I wasn't planning to. It was cash flowing nice, but I kept getting updates from the mortgage company saying, here's your estimated property worth. And I kept saying, no way. And I sent you one and I said, this doesn't look right. And you said, yeah, no, I checked with them. That's way too high. It's kind of like getting a Redfin estimate. You just assume it's an AI, doesn't make sense. But I kept getting them, and it had gone up $50,000. And eventually you said, yeah, I did a comp analysis, or I had them do a comp analysis, and yeah, that seems right. And so I said, all right, well, in that case, I'll sell. And now I'm going to turn that into a triplex. So it's that power of leveraging up. So I'm going to go from 2 doors to 4 doors without any out-of-pocket money, assuming the first one sells and the second one goes through, but that's just that power of that leverage over time. And I'm only 2 years into this. And so my goal is 10 by 40, wherever you're at, just starting with one. $300 is not going to change your life. But especially if you can do it strategically, like IBC, where you're not putting out-of-pocket money. I put nothing out of pocket. I don't have to pay the interest on the policy loan. I will, but I brought no dollars to the table, and now I have 4 properties without ever putting a dime of my actual money in a savings account, essentially, into it. If you understand what we do with IBC, that might not make sense if you also don't understand IBC, but if you do, it's just a really cool tie-in of our 2 businesses.
Yeah, extremely powerful. And I love how you keep saying, like, if I choose to pay it. I mean, what mortgage companies get they make you pay it. So anyway, that's a really cool part to use your down payment to do that. And we, several years ago, we did show the numbers when buying properties with the infinite banking, and the numbers were so out there on the returns that people didn't believe. It was too good to be true, is what we kept hearing. And so we pulled it off, but we've since revisited. We're like, we need to get that back on there, because why would we not show reality? Even if it's hard for people to understand, they need to see it, and they need to understand the power behind it.
Absolutely. A company that I work with, it's called Truth Concepts. They do a lot of software and calculators and stuff, and they have a phenomenal. We'll have to look at it offline here one day and see what you think. But real estate calculations using infinite banking, and yeah, the returns go from potentially 10%, let's say, on your investment, to almost infinite when you consider the fact that you're using other people's money, and on the return of your real dollars, because your dollars are still being productive when you use IBC in the form of leverage, and the control that Hans keeps mentioning on what you have to pay back, when you have to pay it back, how you have to pay it back. And it really can't be beat in a system, but putting these 2 together, it's fantastic.
For the example, I'll just go right back to what I was saying, just to put some numbers on this. $30,000 policy loan, $100,000 mortgage for a $130,000 property. I use a policy loan, I incur $1,500 of interest a year. Let's just say, for this assumption, and this is the assumption I make in my policy loan article, where I actually walk through my strategy with RP Capital. We could put that link in the show notes. If I choose to only pay the interest out of pocket, that's my only out of pocket expense. Every year I pay $1,500. I keep that loan amount static at 30. Yes, I do have an outstanding loan, but I don't have to pay it. If I just choose to pay the interest, then my cost to me is $1,500. And if we assume $300 cash flow per month, then my annual cost is $1,500, but I am bringing in 4 times that in rent, right? Because in 6 months I've paid off that policy loan interest, right, at $1,500. And so the other 6 months of the year is profit, right? So that's a 200% rate of return. And so where else are you getting a 200% rate of return? If I look at what I'm doing in the market, I could be getting a 10% rate of return. I'd be ecstatic about it. But here, for every dollar that's coming out of my system, 2 are flowing back in. And that's current cash flow now, not future value that I can't touch until I'm 65, because I need that time to compound.
And because you're doing that, if you choose to start paying the loan repayment, what people need to think about is that it really works like a line of credit. Every time you make that repayment back in against your policy loan, that money's still available and reducing the interest cost. So it stays in your own ecosystem, and it really keeps expanding and giving you an even greater rate of return beyond what you're talking about. You're making a worst case scenario there. So that 200% rate of return is like Hans's worst case scenario if he chooses not to make a loan repayment for some reason. And just the control and the power there. He could have it, like Shane talked about earlier. There could be maintenance needed on the property. There could be a vacancy. And so he just doesn't have to pay it. And he has 6 months of flex time before he has to dip in his own pocket to make that interest payment, to make sure that the ship gets righted in that time. It's a phenomenal way to handle that.
And with returns like that, why would you not do that, and do that with a passive option that has so much less risk and headaches? I mean, those are the kind of returns that you compare to an incredible rehab. And so to be able to do that without all that extra time and effort and risk is just overwhelming.
And you mentioned that, like, $300 in cash flow, you're not going to quit your job, and that's true. But like you said, when you think of this as an expanding system over time, you're really going to have like a strike number. What would it take for you to be able to go on strike and not be worried about your job, or for you to give your job a pink slip, right? Let's say that you require $6,000 a month for all of your family's expenses. Each property you buy, each time the rent increases, each time that you're able to pull money and buy another property and do what you're doing, you're coming closer to that number. And in 7 to 10 years, passively, without having to step foot in these properties, leveraging RP Capital and their network and everything that they do, you can slowly over time build up a system that is going to take over. And I like to think of it too as like, I can take over a payment at a time. How many houses do I need to take over my personal mortgage? How many houses do I need to take over my car payment? How many houses do I need to take over all of my utilities for my personal home? To do something where you're saving this money using infinite banking and then utilizing that money to build that cash flow, over time, it's just a self-perpetuating income stream that is going to allow you to not have to keep working ultimately.
It's so much faster and so much easier to make that passive amount to cover your mortgage than to pay off your mortgage entirely. You're looking hundreds of thousands of dollars. They're going to take you how many years to pay off versus a few years and a few properties, and you've covered your mortgage payment already. And that creates so many options. And so many people look at that, oh, I'm finally free because I don't have my mortgage payment. If you shift that focus a little bit and just make enough passively to cover your mortgage payment, so much easier to attain, so much faster to attain. And what you just explained, Brian, is exactly what I do with people on the first call. We create a wealth plan and we find out what their personal goals are. What are they looking to accomplish? How much does it cost for them to live till they can quit their job or whatever their goals are? And then we look at it like, okay, you've got this much to work with and this is your goal. Here's how we can get you there. And this is how long it'll take. And then there's all kinds of levers you can pull too and say, okay, this is where we arrived at first. But man, if I do this or this little tweak, it can move that up a whole year or whatever the case is. But we have some amazing software that I show and then I share with clients, and then they can log in there and they can have a very defined plan of this is exactly what I got to do to hit that goal.
How can owning passive properties even improve your family's life in ways? Like one thing that people talk about that I really like and agree with is instead of the 401k, like what about the 401 lake house? Instead of sinking $18,000 a year into your 401k, what if you bought a lake house that cost you that's probably going to appreciate, and you're going to build family memories and you're going to build exciting times and you're going to do all these things. But what if you could do both? Like instead of the 401k, you buy passive properties that can then purchase you a lake house. So we're not even, then you don't even necessarily have to quit your job, but you can expand your lifestyle for your family and enjoy life more, because what you're doing in this passive way through someone like RP Capital and what Shane teaches can help you buy that lake house that you just can't quite afford on your salary. Everybody's life gets better in the process. It's the ideas are limitless. It's infinite.
And we talk about retirement age, 65 is everyone, that's when people are just trained to retire, and we don't really believe that. But if you're going for that, we're talking about, you have your numbers, like Brian said, maybe it's 6,000 that you need to cover everything. Even if you're not 100% of the way there, if you get halfway there, now you have the freedom where you can take a 50% pay cut. So if you're not happy at your job and you have something that actually excites you that you want to do, you might not be able to walk away from work entirely, but you can walk away from a job you don't like, and you could find something. Maybe you just want to fly, Cessnas as an instructor, and that's going to be a 50% pay cut, but you love doing it and the field is close to whatever. Like, you can make lifestyle improvements, quality of life improvements, staying more with home with your family, more kind of improvements, because 50% of your required, monthly expenditures is covered by these rentals. And again, it's not linear in that, if you acquire one property a year, you're not just linearly improving your cash flow over time as the system builds and you use it. If you do IBC, you're paying down your policy loans, et cetera. Your growth from year 1 to year 2 is going to be a lot less than your growth from year 10 to year 11. So it's going to start really perpetuating itself, so that maybe in 7 years, you have half of your needed cash flow. You get to $3,000 a month in this example, but it might not take another 7 years to get the other half. You might by 10 years, just because of the nature of one, appreciating assets. Just like I said, I'm going from 2 to 4 without spending any out-of-pocket costs as far as doors, So thinking cash flow like that versus net worth. And if we go back to your example of that first house, had you paid it off and you put all your money that you got from working, all your extra capital into paying down that mortgage because you want to get rid of that mortgage so that you can increase your net worth, right? Well, you would still be at one property and it still wouldn't be paid off. You might have paid off 70% of it if you were aggressive, but the only thing you could do with that doesn't provide you a single dime of cash flow unless you take a HELOC out, which is essentially a policy loan with way more restrictions to pay down that mortgage early versus now having 8 properties all off of that one. That is the cash flow versus net worth mindset.
And a lot of people get hung up on, well, I just don't want to owe the bank anything. And until they think of it this way, like, look, even if whatever worst case scenario comes up and you need money, you can sell the property and within 2 months have the cash out of it. It's not that difficult to pull, or you could do a HELOC. There's ways to get a HELOC within a week or two. So the money isn't completely tied up. You do have access to it's there. And so usually when people understand that, they're like, okay, now if I look at it that way, they're more okay to get a loan on a property. because yeah, the numbers are insane. I mean, it quadruples your return every year without infinite banking, just in the property itself. If you just get 3% appreciation, or if you put 25% down, that 3% appreciation becomes, 12% return. And so you're increasing just on 9% just on that one thing alone by leveraging.
Yeah, Shane. So actually, if you can speak to that in a little bit, I want to be respectful of your time too here. I don't know how long you have, but all the possible ways that somebody doing this by purchasing income or producing properties on a passive sense, what are all the ways that they can make money? Because we keep talking about the cash flow, but that's not sitting in a silo where it's the only way you're making money. These properties do a lot more for you than that.
So there's 4 returns in real estate that we always refer to. So the one is cash flow that we've already covered. The second is principal reduction. So just by paying the minimum monthly mortgage, you're going to owe less on the mortgage each month, because a portion of that goes towards the principal and the majority of it upfront goes towards interest. But and it depends on the property, but after 1 year of just making your minimum standard monthly payment that's on auto pay, you're going to owe a few $1,000s less on that property than you did at the beginning. And so that's one other return. And that's usually about 3%, 3 to 4% on your yearly return. And then there's also the tax benefits that we haven't even touched on yet. So standard depreciation is about a 25% income tax bracket. That's going to be about another $3,000, about a 3% return typically as well of cash in your pocket, because you're getting the tax benefits, because the government knows that property is going to fall apart over time. They know that eventually you're going to have to replace the siding and the appliances and the flooring and all those things. And so you get that tax benefit of doing that. And so that's another big benefit. And then, hey, when there is a vacancy or maintenance costs, and those are things that can help. When we sold this property this year, I ended up keeping a portion of it. So we bought 3 properties with it, and then I kept some to have it be taxed on, because we had like $60,000 in passive income losses built up over the years. My accountant told me about it. He's like, yeah, you can take $60,000 in cash and not even pay taxes on it because of all this built up losses you've had. So we chose to do that. So it just provides options, and the tax benefit is really powerful. And then the appreciation. So those are the four returns.
So what is your plan now? Originally, hospital construction, keep moving around till retired age 65. Do you have a retirement idea now? Do you know how many properties you're going to be looking for? Is it just going to be continuing to purchase and acquire? What's the future look like for you?
Yeah, good question. It's interesting when you hit your main goal, which for me was to get out of construction. Like I don't clock in, clock out, I was salary, but I'm not tied to a job site. I'm not married to a job site and all the headaches and problems that come up daily there. So I got out of that a year and a half ago, and I've been working with RP Capital for longer than that. I did do it part-time on the side while I was kind of straddled both of them for a while, and that opened up a lot of opportunities for me. I'd always wanted, you're kind of talking about Cessna and teaching and things like that. I ran a little bit of track back in the day, and I always wanted to coach it, and I loved it. And I thought, I'll do that with my construction job when I get the time. Never had time in construction. Last year was my first year helping with the local high school track team. Absolutely loved it. I just don't have to make my decisions based on, well, do I have the money for that? We live within reason too. Like, we're not crazy, we don't have insane expenses. And so we stay within what we normally live within, but money is not the main determining factor of what we do or what we don't do. So coaching track, and the reason I bring that up is coaching track pays absolutely nothing, but it takes a lot of my time for 2.5 months, and I love it. And I don't have to only do things that are going to make money. Like, that was the biggest goal, to spend more time with family and all those things while the kids are still home. And so right now we're just continuing to grow that portfolio every chance we get. So, and we're at the point that we're selling a property every year and doing a 1031 exchange to get 2 more. And then it'll get to the point that it makes sense to sell 2 or 3 or whatever it is. No matter how large it gets, we still want to be a good steward over our money and maximize the returns on it, whatever that is. And it's so easy to do to sell a property and buy a couple more when you're not going to see them and all those things. So we just shoot to continually grow the portfolio and just continue to have more options.
Which we love. We've recommended you multiple times with our clients, and we want to continue to do that. There are other companies out here that do turnkey real estate. Most of the ones that I'm familiar with, aside from RP Capital, everything is done in-house. So what sets RP Capital apart, and why should people choose you if they started getting online and looking up ways to do turnkey real estate as a investment process?
Yeah, good question. I don't know everything about the other companies for sure. We don't charge. We're a zero cost service to our investors because we're a real estate brokerage, and the way we get paid is after a client buys a property, we get paid from the seller, just a standard real estate commission. So, and then we don't charge for any of the other, portfolio review, the franchise mentor piece I was talking about. That I'm extremely responsive. I help people out with their questions down the road.
Can confirm.
Yeah, thank you. I don't like to let the ball sit in my court. If someone asks me a question, I'm gonna get back to them. And so it's the high touch, plus it's also the high tech that we have the software, and you can get a specific plan of how to get there. And then the combination of the two is just really powerful to be able to help people reach their goals. And we've helped lots of clients. 19 years, thousands of clients, and over 70% of our clients are repeat buyers with us as they continue to grow that portfolio, as they stick with it over the years. That we've truly seen lives change, and happy to do it for the next person.
I think you're leaving something out that has been alluded to in multiple parts of this conversation, but a lot of turnkey companies are very regional dependent because that's where they're based. And I think where one place RP Capital shines is like you've mentioned, you will change markets, you will build relationships in different markets based on what makes the best sense. So I live in Pittsburgh. If there's a company here in Pittsburgh that does this and they're central to Pittsburgh, well, if this market changes, they're still staying central to Pittsburgh. It might not make sense for the consumer anymore. I think that's a massive strength for you guys, is that you have relationships all over the country and you're willing to flex and flow with the natural changes in the market. I think the other thing is like we already talked about, is that you go in, you've got the power of a whole group of people in every market you go to. So you're helping multiple investors with the same companies. It's almost like being part of a big portfolio as a small time investor when you're getting started.
Yeah, those are really good points. You're right. I did undershoot that.
Don't undersell it. I love that. That's one of the reasons I choose RP. It's awesome.
Yeah. Leaves the options open for sure.
Well, I think your example of being able to coach track for no money because you love it, because you have offset your expenditure requirement with passive income from doing this, is the perfect ribbon to tie on this. How can people reach out to you? I'll say one thing is, if you want to email us, info@remnantfinance.com, and just say, hey, introduce me via email to Shane. We're happy to do that. But how do people find you? How do people find RP Capital? And what do you want from people who want to get into this?
That's a great way. They can reach out through you, and then you can connect me. Or you can email me directly as well. So Shane@rpcinvest.com. And the first thing that I'll want to do is to have a conversation with you, have a Zoom call, and get to know you a little bit, find out what your goals are, what your situation is. And I love that part of it, because no two situations are alike, and do a custom one-on-one, we call it a wealth plan, and develop where you can go from there. And I'd love to sit down and have that conversation with lots more folks.
You've referred to Ron Phillips, who started this company, hence the RP. He has a podcast as well called Get Real Podcast. So it's specific to real estate, it's specific to what they do, but also good commentary on market conditions, et cetera. So the Get Real Podcast will answer a lot of these questions that if you have additional questions on the process and on real estate in general. So I highly recommend it. I listen to it every week, and you've done an interview on there recently.
Yeah. And you're right. There is great info in there. I use that a lot when people ask questions. I'm like, you know what, check out this podcast. It goes more in depth, and there's already 20 minutes on it. So lots of good info there. You're right.
Yep. Really is a great podcast. And, but yeah, you're our point of contact, and you're our personal rock star in the business. So we want to get it, refer as many people to you direct within that system. So happy to have you here, man.
Great. Yeah. I appreciate it. It's been a pleasure, and looking forward to the next time.
All right. Thanks for coming on. We'll see you.
See you.